Hi, it's Brett Senkis, the Right Brain Business Attorney, and today we're doing another What's the Difference Between? So today we're talking about what's the difference between angel investors and venture capitalists. As is usually the case when I do these, the answer is not much. I mean, at least from a broad perspective. Angel investors and venture capitalists both invest money into private companies, hoping that they'll grow. Right, so they put money in almost always as an equity position, meaning they take stock or something, hoping for a company to grow. Now, angel investors tend to operate with their own money. I mean, that's kind of what would define an angel investor is they're using their own cash. And sometimes it could be someone who has a full-time job doing something else, and they're just looking for small deals, private companies who need growth capital. Sometimes they're organized more formally. Sometimes they have clubs, right? They're still sort of each doing their own thing, but they're trying to source deals together. Other times you will see some groups that call themselves like the Silicon Valley Angels. I don't know if they're still around, but they're really kind of like a venture capitalist a little bit. And so venture capitalists, what defines them is they're using other people's money. So they usually have much bigger pools of money from pension funds and sovereign wealth funds and other very well-heeled private individuals and family funds and things like that. So big pools of capital. So they're using other people's money. They may use a little bit of their own, but fundamentally they're managing other people's money. That's the big difference between the two. Because venture capitalists have much larger pools of money, they're looking for deals that are larger. Because if you're managing a $100 million fund, it doesn't make sense to do that in $250,000 chunks. I mean, you'd have 400 investments and you can't manage that all. So venture capitalists are looking for bigger deals, which means they're looking for companies that are a little bit further along the growth, the life cycle of a company than, say, an angel investor. So an angel investor might put in $100,000, $500,000 in a seed stage or even friends and family kind of round deal very early on. Venture capitalists won't get involved until Series A, Series B, Series C. So you've heard me talk before that financing all proceeds like that. You've kind of got your friends and family seed and then A, B, C, D. And there's nuances. There's A minus. There's all sorts of stuff people come up with. But the point is the rounds the company continues to grow, de-risk, need more capital to grow on their way out the door. Both angels and VCs are usually looking for home runs. They're not interested in investing in my law firm. They couldn't legally, I guess, because I'm not allowed to have investors like that unless they're licensed lawyers. But the point being, they don't want little professional services businesses. They don't want to invest in cleaning businesses. They want things that can really scale. Angels and VCs tend to be the same way, although angels sometimes are a little bit more opportunistic, maybe a little bit more interested in things like bars and restaurants and stuff like that. But again, the broad point is they're very similar, slightly different sort of at the margins, but they're both looking to invest capital in the companies that are going to grow and grow quickly and large. A few questions about early stage financing, angel investors, venture capitalists, rounds, how you structure those deals, equity versus debt. Give me a call, drop me a line. Thanks.